This time around from Navneet Munot, CIO at SBI Mutual Funds, who shares his market outlook in the sectors you should be betting on as the markets prepare for life post-elections.
China has its own set of issues with the geopolitical risk. Money may not go to Russia and some of the European countries. Similarly, I think all the other commodity producers are going to get impacted, and then India has been a beneficiary. Also, I think at a bottom-up level, the quality of companies that you get in India compared to most of the other emerging markets, I think they've also been responsible for ensuring a larger flow come to India. It's unlikely to change in a very big manner. If you get a better political outcome, you're getting a cyclical recovery, then of course the attractiveness of India goes up. Even otherwise, if you look at the global liquidity situation, Fed is likely to taper a little bit, but you watch European Central Bank, ECB is going to print a lot more money. Their money supply is not growing, inflation is 0.5%, so they have to print a lot more money. I think BOJ will continue to print more money to get their inflation objective. The global liquidity scenario is unlikely to change. We'll look at the valuation of most of the assets, I mean in terms of developed market equities, in terms of junk bonds, in terms of high-grade bonds, government bonds, most of the asset classes. I think relative attractiveness of Indian equities as well as the bonds, we will continue to ensure that we get more capital flows. And of course, it may get bunched up if we get a favorable political outcome. There may be a bit of volatility if we don't get that, but ultimately, in next couple of years, I think we deserve a lot more money than what we have got.
Okay. Now, let's assume that flows are strong. But historically, we've seen that global investors, they've always bought into quality stocks, whether it is IT, pharma, maybe private banks, and some FMCG names. You're not bullish on those groups. What you're bullish on industrials. So if one assumes that flow is here, money is going to move into quality. It's not going to chase industrial or economy-related stocks.
First of all, I mean, industrial doesn't mean that they are not quality. There are several quality names there, and what we have bought is quality. Even, I mean, having said that okay, there are ways to play the cyclical recovery and buy more cyclicals, but the single biggest overweight probably we would have include pharma. But that's a bottom-up call. That's not a top-down call just because we want to be so-called defensive versus having aggressiveness into the portfolio. But individually, when you look at those companies, you like those companies.
So there are enough quality industrial names available.
Industrial, and there are quality names within IT and pharma and financials and industrials as well. Maybe some of these industrials, and particularly the domestic plays, whether it's industrials, whether it's some of the other discretionary spending. I think as the overall economy recovers, I think there are several names to look at from that basket also.
So let's now start dividing sectors. Now, I know you're a bottom-up stock picker. We can't discuss stocks, but our viewers are always curious to understand your views that how are you investing right now? Probably some of them are also, unit holders of SBI Mutual Fund. Is IT still looking very cheap? Because if I look at the most expensive large-cap IT stock, that is TCS, it is trading at a P multiple of about 20 times. HCL Tech is trading at a P multiple of 14-15 times. That is not a stretch number for a quality business where companies are growing at a run rate of about 15-17%. So do you think somewhere even after the recent run-up, the margin of safety for a long-term investor in IT is still supportive?
Yeah, what has happened that in last couple of months, because the rest of the market has gone up, so the relative premium for IT has gone down, and that's the case with some of the other defensive sectors that you mentioned about. But again, we are like purely bottom-up. I mean, wherever we see that companies that are getting bigger deals, companies that are looking at newer geographies, newer segments, newer businesses, investing into what can potentially be bigger businesses going forward, those are the ones that we are betting on. In terms of the extent of overweight above the benchmark, I think would have gone down in our case.
That's only because you have a positive view on economy. You expect economy to come back, so for the moment you're ready to trade off. And the fact that you're neutral on IT, it's more like a tactical trade.
Yes. Technically, I mean, we like those companies for the reasons that I just mentioned to you. So they have been a big beneficiary of the rupee depreciation also. Apart from the robust demand environment, and companies have done well, they've really invested well into building their business. And overall, globally, I think if the demand environment, I mean, whether apart from the US, even some from Europe and some of the other markets, if continue to do well, then some of the companies may do well.
The minute we say industrials, I can think of at least 500 names. Let's dissect industrials into some 2 or 3 large groups. One end you've got asset owners, somewhere in the middle you've got machinery companies, and then you've got real builders. What do you like within industrials?
I think high quality engineering companies is one space. I think some of the companies have invested well, and if I can say the word, I mean capital light model where the balance sheets are intact. You don't have too much of leverage because a large part of the other industrial space, the other segments that you mentioned about, are still saddled with huge amount of debt in their balance sheet. So their ability to participate in the next cycle of growth is very limited. I have a view that I think the infrastructure, I mean, if I can use the word boom, I mean, maybe it's a little early to talk about it, but at some point in time we are going to see the whole economy, particularly in case of India, shifting a lot more from the consumption to the investments. We have to invest a lot more. The new government, whosoever comes to power, what they have to deliver, because what is the election agenda? Jobs and bringing inflation down, maybe a little bit of corruption and all that. But these are the two big issues for which the young voters all the voters are voting for the jobs.
Fair point.
So then you have to increase the productive capacity of the economy. There's tremendous amount of investment, whether it's railways, whether it's ports, whether various kinds of investments are going to happen.
So broadly, you are betting on economic or proxy players, whether it is a port company, whether it is a player like Concur, or whether it is a company which will benefit if the industrial demand comes back.
Several things. So let's say sustainability, we believe, is going to be a big theme. There is going to be a water shortage. Companies that have invested, it may be a small segment of their business as of today, direct play maybe only one or two, but it's going to be a big business. India will need a lot more, I would say, potable water than it can supply to its people and to its industry and to its agricultural fields. Similarly, even globally, I believe that in next several years, there could be, apart from the capex for some of the manufacturing capacity, whether it's US, whether it's Europe, whether it's Japan, how will people get out of this current economic mess? They've printed as much money as possible, but still they are struggling to get that growth. How that growth will come back and how the jobs will get created. They have to invest in infrastructure. In US, you travel and look at the condition of the airports, look at the condition of the roads. They haven't done anything for their railways. The grids have to change. Electricity, there are new solar and the other electricity, so you need a new kinds of grids. So I think there's tremendous amount of investment which is going to happen globally. It may be a little early to talk about it, and you need to think a little longer term. Are there companies in India which can benefit from that global cycle, which I think is not only going to get restricted to India, but I think several other parts of the world, and I think that there are some plays available.
For the longest time, you've run a very consumer-centric portfolio. Page Industries, United Spirits, some auto replacement stocks. Is the big consumer theme, is that consumer wave over now?
No, not at all. There are several of those companies. So there are different parts of the portfolio. We have a fund, Magnum Global, where we buy quality companies with a much longer term orientation. Some of the names that you mentioned are still very much part of that portfolio, and some of the other portfolios. I think still, even in terms of consumer, I mean, there are opportunities on the cyclical side of business, but even in consumption, I think that the penetration is very low. There are several names where you can easily extrapolate 15-20% growth for next 20 years. The markets are so underpenetrated. So you have to pick and choose. But in terms of valuation, yeah, maybe I think some of those stocks are fairly or maybe a little overvalued because there was paucity of ideas for the market. But still, if you have slightly longer term horizon, I think there are several plays in that segment also. And that's the beauty of the Indian market. I mean, across, whether it's technology, whether it's pharmaceuticals, whether it's consumer, and now you have got a whole range of businesses, whether it's media, whether it's auto ancillaries, whether it's a lot of industrial that we discussed. You have lots of opportunities of bottom-up stock picking.
The fact that you are bullish on industrials or economy-related stocks, are you not worried about the election outcome? Because let's be real here. The election verdict will be a 10-15% swing event for our markets.
That's why I mentioned that we are buying quality industrials, not sacrificing on the quality, not buying
quality could also
those companies that where there's tremendous amount of financial leverage. You are looking at, as I mentioned, capital light model and those who have invested. Regardless, I think whosoever comes to power, we believe that I think investment as a percentage of GDP has to go up over the next several years.
So you're very clear on your approach.
The maintenance capex has to go up. So let's say we have lots of these bearings companies. I think they have handle the downturn pretty well. What happens in a downturn, I think companies where the management has a vision, where the management has the ability, I think they are looking at not only restructuring their balance sheets, I mean wherever there are issues, but even otherwise in terms of operations, in terms of their resource allocation, in terms of, I think, investing into the future. Those who have taken the right steps, I think as and when, even if, I mean, the recovery is slow and takes time, I think the operating leverage is so high that next couple of years, I think the opportunity for some of them could be very large.
Navneet, we've seen a one-way ride for Indian equities. From 5,500, Nifty has moved to 6,800. Do you think there is somewhere some froth in the system? There are a lot of port names, there are a lot of industrial names, there are a lot of high beta names which have appreciated by more than 100 to 200% from the recent lows.
Not at all. I think overall market as a whole, the PE is around 15 odd times. We are still, I think, in terms of price to book. Yeah, but it's fairly valued. I mean, you have to look at earnings also. Compare that with the earnings. So our overall earnings as a percentage of corporate profits, a percentage of GDP is half of what it was a couple of years back.